today's golden nugget was how do a syndicator get paid? And again, it's number one, the profit split, general partner, limited partner. Number two, an acquisition fee. Number three is an asset management fee for managing the manager. Number four would kick in if there's a refinance fee, a hurdle, or some benchmark that's been hit. And then the fifth way a general partner can get paid is being the guarantor on the mortgage or the loan, where they could carve out a percentage of the deal or a flat fee or a combination of both. Hey, what's up, everybody? This is Brian Lucer with another golden nugget for all of our Why Not Real Estate peeps out there. Today, what we're going to do is we're going to unpack how syndicators get paid. When you do a syndication deal, we already know that people pool together their money. We have general partners who supply the opportunity, limited partners who provide the funds to the opportunity. They come together. Limited partners get paid, general partners get paid. But in this video, we're going to boil down on the GP, the general partner side of the equation, and just pull back the curtains a little bit and explain how syndicators get paid or sponsors get paid when they do a syndication. So the first thing we're going to cover is the profit split for the general P, the general partners and the limited partners. Basically, the way this works, the syndication is split between the general partners who are bringing the opportunity to the table and the limited partners who are investing in the deal. A general partner can also invest into the deal and be on the limited partner side of the equation. So the general partner, if they put money in the deal, have the same perks and benefits that a limited partner would have. They would receive that part of the split. So in your typical syndication deal, if it's a 30-70 split, 30% ownership would be for the general partners in the deal. Then 70% of the deal, the distributions would go to the limited partners. That's pretty much the split part of that. Now, if a general partner chooses not to participate into the deal, they would not get the benefits of the limited partner split. I would also caution you investing in that deal because I would want to see an alignment of interest. If the general partner feels so strongly about the deal that they're going to invest their own money in the deal, then I would see an alignment of interest that they have the same risk that the limited partner is going to do of losing money on the deal. So first step is the profit split. That's how a syndicator gets paid on the deal. The second way a syndicator can get paid on a syndication deal is through the acquisition fee. Now, an acquisition fee, typically industry standard, is anywhere from 1% or 5% of the total purchase price of the property. This is paid at the closing table as an additional fee for the closing. You've got your lawyers and all the other things. They need to get their slice of the pie at the closing table. An acquisition fee is just another slice of that pie. And this is set aside to the general partner. This compensates them for putting together the deal, having all the negotiations, the contracts, the underwriting, everything that they have to do to make this deal work and bring it to the table. It is a lot of money. There are a lot of moving parts, and it's a lot of work to put one of these syndications to put together. Now, is it really a lot of money? Typically, industry standard might be 2 to 3% of the deal, but it ranges depending on the size of the deal, anywhere from 1 to 5%. 5% might be for a smaller deal, which the numbers might be a little tighter. 1% would be for a larger deal where there's more meat on the table to go around. So we've got the profit split. That's the first way. The second way is the acquisition fee. And this is, again, a carve out at the closing table. Now, the owner could, the GP could take their acquisition fee and invest it into the deal to be on the limited partner side of the deal. Now, that is a really nice thing to see the general partner do. It shows that they believe in the deal. They're putting their own money up front, and they're not just in it for the fees and gains that they would get from that syndication. So we've got the profit split and we've got the acquisition fee. The third way a sponsor or syndicator can get paid on a deal, something they bring to the table, is the asset management fee. Now, the asset management fee is the month-to-month, week-to-week, daily task of managing the property manager. When you do this type of deal, there's usually a business plan where there's a plan in place on how to value add the property. It may mean renovations or cutting expenses or shifting around how the property operates to make it a higher value. So managing the manager is called the asset manager. Okay, the asset manager is typically the general partner, making sure that all the fine minutia of the business plan to up the value of the property is being met. This means they may meet on a weekly basis, either on a call, a Zoom call, or sometimes the general partner can surprise the property manager and show up on site. They can jump on a plane and be there. During these meetings, the property manager will benchmark the progress on the business plan to improve the property, and the asset manager will then disseminate that information to the investors to keep them apprised of what's going on in the situation. Typical asset management fee could be 2%, or it could be a flat rate fee of $150 up to $250 per unit annually. Okay, so that's all predetermined in the operating agreement before it gets started. And again, this fee is for the general partner to manage the property manager, disseminate the reports and information, and keep the limited partners up to speed on what's going on in the deal. Another way, a fourth way, that a syndicator can get paid on the deal is a refinance fee. Now, this is kind of out there as far as the fees go, but in a nutshell, if the property manager and the GP are implementing the business plan and raising the value of the property, then the plan is that we should be able to refinance the property. And again, this all depends on per property, per deal. Is the deal to go in and sell the property? Great, then we deal with that as in and out. But if there's enough meat on the table and the plan is to buy and hold for a longer period of time, then there could be benchmarks set on a refinance fee. If the general partners, as the asset manager, increase the value of the property and they can refinance, then if there are certain hurdles that are met, let's say that if the GP is able to, on refinance, pay back 50% of the limited partners' cash into the deal, their cash contributions, then that may trigger either a 0.5 or 2% refinance fee. If they've done a really good job, raised the property value, and were able to pay back the investors whatever that benchmark might be, that's all predetermined in the operating agreement. But if they hit that benchmark, then the refinance fee could kick in, and that could trigger a tiered agreement depending, if they hit so much money, they get so much. If they get more, they get so much. And again, that's all going to be upfront in the operating agreement. And if that amount is achieved by the refinance and all the target hurdles outlined in the operating agreement. Just to rabbit hole off that, say the refinance fee is not going to happen and we actually sell the deal, then the payout of the deal, after if there's any waterfalls or any preferred returns, then it would revert to the 30-70 split or whatever the split was on the profits after everything's paid. So the refinance fee is during the life expectancy of the deal, and then the payout would be if you actually close and dissolve the asset, sell the property, okay? The fifth way that a syndicator can get paid on a deal is called a guarantee fee. Now, the guarantor is someone who will come into the deal as a sponsor of the deal. Most people don't know this, but if you do an acquisition where you're pulling down a syndication of the deal, then the net worth of the general partners must equal the loan amount for that deal. So if the loan amount, say it's a $5 million deal and the loan amount is $3 million, just to round up some numbers, then the net worth of the general partners must meet or exceed $3 million. It must be equal to or exceed. Okay, so the net worth of the general partners equal to or exceed the amount of the mortgage. Maybe if they're starting out, maybe that's not going to happen. So a general partner can bring in a guarantor. Now, the guarantor has the net worth to meet the requirements of the mortgage. So they'll either offer the guarantor a slice of the pie, maybe they'll get a equity stake in the property, maybe they'll get a percentage. It could be 2%, pretty much industry standard, depending on the size of the deal. It could anywhere be from 3.5% to 5%, depending on the size of the loan. But the guarantor comes in and signs the mortgage document. Now, typically, this needs to be a non-recourse loan because we're not going to have a sponsor sign a mortgage and then be on the hook if something goes wrong with the property. If something goes wrong with the property, the bank takes the property, and under a no-recourse, non-recourse loan, the sponsor is free and clear. The guarantor has no further risk. They're not going to be in trouble on that, okay? The general partner may offer the guarantor. I was saying it could be a percentage of the deal, a portion of the deal, or it could be any portion of that 30% carve out that the GP has. Or, as I said, it could be a combination of both. It could be some equity in the deal, or it could be a predetermined percentage of the mortgage. And those are the 5 typical ways, most common ways that a syndicator would get paid. Again, just to review, the 5 most typical ways that a syndicator can get paid on a syndication or a property that they bring to the market. One would be the general partner, limited partner split. That's the profit split. Typically, it's a 30-70 split. The second way would be an acquisition fee, which is anywhere from 2 to 5% of the amount of the deal, the purchase price of the deal. Industry standards around 2%. That pays the syndicator or the general partner for all the hard work and heavy lifting to put the deal together, bring it to the table. Third way would be an asset management fee. That's generally the general partner managing the manager and disseminating that information to the limited partners to make sure we're on track to meet our targets and our goals. The refinance fee would be a predetermined fee that the syndicator would earn if they hit the certain benchmarks on a refinance to pay back the capital contribution of the limited partners. If the limited partners get paid back, great. If certain milestones or hurdles are reached, then the syndicator achieves the refinance fee and gets paid that money. And then the 5th way would be a sponsor coming in to sign on the mortgage. This is a guarantee fee. The guarantor has the net worth to cover the amount of the loan balance for the syndication, and they typically will be offered a split either of the equity or some of the portion of the 30% for the 30-70 split. So I want to thank you all again for joining us on another Why Not Real Estate Golden Nugget. Today's Golden Nugget was how do a syndicator get paid? And again, it's number 1, the profit split, general partner, limited partner. Number 2, an acquisition fee. Number 3 is an asset management fee for managing the manager. Number 4 would kick in if there's a refinance fee, a hurdle, or some benchmark that's been hit. And then the 5th way a general partner can get paid is being the guarantor on the mortgage or the loan, where they could carve out a percentage of the deal or a flat fee or a combination of both. Thank you again, all of my Why Not Real Estate peeps, for joining us on another Golden Nugget from the Why Not Real Estate podcast. Thanks for tuning in. See you on the next one.